Hello, Maverick traders. Welcome out to your trading room. This is in preparation for the week ahead, September 18th through the 22nd. Let's get to it. So we always start with the top-down approach of the markets. What was making markets move? S&P, Dow, NASDAQ. We're going to look at those major markets. Then we're going to dig into the sectors, and there were some interesting changes in the sector dynamics this week, specifically tech. Had a really bad week, and as tech goes, so goes the market, is certainly something that has been true for most of this year. Trading setups, we're going to highlight a few, and we're going to focus on the bearish side a little bit more than the bullish, which is a change because we've been in this sideways consolidation. So we got some really nice trade ideas coming up.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
All right, so let's take a look at this past week. This past week, we had a nice rally going for the first part of the week, but Friday turned ugly, and it turned quite ugly. Tech, specifically, we'll talk about ARM Holdings, which was an IPO. They really derailed the market rally and gave back most of the gains. Tech turned very negative on the week from Friday's price action. Economic data this week was fairly stable. CPI was up a little bit more than expected, so we knew the inflation rate was going to jump, but it jumped to 3.7 versus 3.6. Now remember, the Fed's target is 2%. They have two main mandates: to keep full employment and to keep price stability. So we're at this level where CPI inflation numbers are still too high. In the last couple of months, it's been ticking back up. I don't think it's ready to just run away to the upside, but there is still work to be done. On the good side of economic data, though, retail sales beat expectations at 0.6 versus the 0.1 expected. ARM Holdings was a big IPO. Major news, it went off successfully. They IPO'd on Thursday. The stock was up nicely. Friday, it gapped higher, and then it just got hammered. So whenever there's a huge IPO like this, though, you do have to say, well, at least the market can handle it. That's the positive side. The negative side is, well, why are these private equity funds trying to sell their tech holdings? In other words, when they were buying ARM, that was a better time to be buying semiconductors. In other words, there was value, there was opportunity. Now you look at it as, well, they're trying to unload and trying to liquidate. It might tell you that they feel like the tech sector, the semiconductors and so on, are fully valued and they want to cash out. So the motivations of those involved is always worth dissecting a little bit closer. So as we said, CPI came in hotter than expected, not what's ideal, of course. PPI came in as expected. Retail sales beat on both the core and the regular. And then the ECB surprisingly raised rates. That was not anticipated. They were expecting to hold. So we're still seeing central banks raising rates. Now, last week's trades, we highlighted 4 different ideas. ADM, Archer Daniels Midland, we highlighted as a bearish to neutral idea. It was more neutral, but you can see Friday's price action, big volume. Looks like it is, in fact, ready and poised to move back down. Pfizer we highlighted as a bearish to neutral trade. I would call that pretty much bearish but low basing. A little bit choppy sideways for the week, but still looks bearish on the chart. Occidental Petroleum we highlighted as a bullish trade, and we went out a little bit further on this one. We went to November, and the thought was that maybe we'd see a little selling in the short term. Well, we got that. You can see the big down candle, but then the rest of the week it was up. So energy's still trading pretty well. Friday we did reverse back down, but it was up on the week, and it's a bullish trade, so that's good. And then Marriott still consolidating, but we suspect this one could break out of this triangular pattern here, and we would give it, expectations would be you would leave the pattern the way you came, so strong uptrend, consolidation, and then the breakout to the upside. Now let's take a look at the major markets here. As you can see, the weekly performance, most things were pretty much flat. The Nasdaq down about 0.5%, but Dow, S&P, Nasdaq, Russell all relatively flat. Oil was the big performer, up 3.8%. And as we said, oil going up is not necessarily bad for the economy in the very short term and if oil prices aren't too high, but ultimately higher oil prices is a drag on the consumer, is a negative for most corporations. So at certain levels, it becomes a concern and it becomes more problematic. Right now, oil and energy has just been going to the upside very nicely. So if we look at the S&P, the chart here, we talked about how we're in the consolidation. I think you can drag your downtrend line across the peaks. You can drag your uptrend line under the valley, and basically it's a symmetrical triangle. It's what a consolidation is. You're just faking out moves up and down, and the moving averages tell the story. Look at how they're sloping sideways. I would say, though, Friday was very, very ugly in terms of price action. Now, we did have quadruple witching, which it means a lot of expirations. It was option expiration for September, which is a big closing point for our Maverick traders. That's when we close the books on the month and so forth. But definitely selling pressure all throughout that day. NASDAQ, same type of dynamic. You can drag your downtrend lines. You can drag your uptrend lines. We're in this symmetrical triangle, and I would lean, and I've said this before, I'm still leaning slightly more on the bearish side. I've been on record as saying that. Now, I've said you don't want to do much of anything other than sideways type of price action, focus on maybe energy to the upside lately, but I think that changes a little bit here. I would just downgrade the markets slightly and say, I suspect, as I've suspected previously, that we are going to leave this to the downside. I would give that a better than 50-50 chance in my mind. The volatility index, huge reversal today, big bullish engulfing formation after what I would call a false breakdown of sorts, where it tried to pierce to new lows here and then big reversal. And when you see these big bullish candles, reversals, there's usually more upside, and a big reversal like that that has a few more days of upside means what for the markets? Well, if the VIX pops here for a few days, what does that mean for the S&P and the Dow and the Nasdaq? They're selling off. Remember, the volatility index moves inverse to major markets. So if we do see this big bullish candle have a little bit more pop, it would mean the market should have a little bit more drop, at least for a couple of days. This upcoming week, we're still in this choppy trading environment, but we could get at least a push down there towards the bottom of the symmetrical triangle, possibly worse than that. Markets are expecting that the Fed's on hold, that they're not going to raise rates, and I think that's true this week. We've got an FOMC meeting on Wednesday. That the Fed is not going to raise rates this time. I think the market's pretty clear on that point, and I would agree. They're not going to raise rates, but are they actually done? Will they say in their statement that they're confident they're done and so forth? I don't think the answer to that is yes. And actually, I would personally anticipate that there are a couple more rate hikes coming. So they'll have their statement, they'll have their press conference after, and I suspect the Fed's going to continue to push the markets this idea that, hey, we're not comfortable with where inflation is at yet. We're not comfortable with these things, and they're going to at least speak to trying to get the markets to see that they're not done. Now, whether they are or not will be data dependent, but I suspect they've got more work to be done. We get central bank meetings out of the UK. We get in Europe some PMI data. But Wednesday, the FOMC meeting is the headliner, no doubt. Now, as we look at the outlook, I'm going slightly lower, I think is a good bet for the markets. You might see a bounce on Monday. Usually when there's a huge candle like that, you'll get a little bit of a harami, a body within, a little bit of a bounce. But Monday's small bounce, if it happens, is probably an opportunity to enter a bearish trade or two, and that's what we'll look at and highlight today. So things have turned a little bit more negative. You're below the 20 and below the 50. Moving averages are still sloping sideways, and you still have to somewhat say we're zero in terms of we're still inside that symmetrical triangle, but that may be changing, and it may be changing quickly. Risk happens fast, and the risk seems to be to the downside for the markets at the moment. Now, if we look at sectors, as I said, most sectors held in pretty well. If we look at the data, I mean, consumer was up, financials were up. This is not a week where you'd say markets look ugly, but here's the ugly one. Technology down 2.25%. It's the highest weighting in the S&P, and it really dragged the S&P and NASDAQ and those markets down this week. Utilities is just it was beaten down for a very long time, and it seems to be kind of a short covering rally or something of sorts. I'm kind of happy I don't trade a lot of utilities because I don't know if I can really explain what's happening there or make heads or tails of it. So as we look at the markets and look at this type of price action, it speaks to you're still in the consolidation. There has not been a complete breakout or breakdown. Utilities, as we said, just kind of an exhaustion low is what I would call it. You plummeted to the downside. You had a big bearish candlestick here, and you can't see it, but there was actually a big volume day that was sort of an exhaustion signal. And from there, we've just been on an upward tear, and every day it just climbs a little higher and a little higher. It's done some recovering. Now, I suppose if the next trade is one you're interested in, it would be a buy the dip. We've made a higher high than the prior pivot highs. We would likely make a higher low than the prior pivot lows. So I suspect a little pullback, you could be in a buying opportunity. I think a pullback and that sort of choppiness looms. Still a zero rating. You can't really get too bullish. Communications. At least here we're above the moving averages. We've got some upward slope. We've got some positive characteristics. Like everything, kind of an ugly day on Friday, but still a little bit more positive on that sector. As we look at real estate, a little bit more downward pressure, but are you seeing some improvements? I mean, the 20 is starting to curl up. It's trying to do that. You're in between the moving averages. I think it's still in that 0 to -1 type of rating, but you would have to say that it's borderline whether you just give this a 0 rating, just kind of say, okay, there was a little bit of improvement there. Industrials, this one, there has not been improvement. If anything, you've pierced the lows now. Industrials are no doubt one of the worst performing sectors, have been for some time. You've got downward sloping moving averages. That's a more clear picture of something that's still acting bearish. Now, if we come over to healthcare, again, you're kind of in this. Do we give it a little more negative rating because the 20 is sloping down, because it recently crossed bearish on the 50 and you're below those moving averages? It's borderline a 0 to a -1. We're going to give it a -1 because you have made new lows, you've come up and made lower highs. This is more bearish than just a 0. So we've gone ahead and given that one a -1 rating. Financials holding up pretty well. 20s below the 50, so that's a mixed picture. That's not really clean and clear. But the 20 is sloping upward. You've gone above those, and you've recently made new highs. So you'd have to go anywhere from about a 0 to a +1. If you want to go +1 on that, I can see that, but you're in that, well, is it neutral? Is it actually acting more bullish? This one I would give a little bit more bullishness than just a 0. So maybe it's a +0.5 or +1. I could see that. Consumer stocks. So here again, you've moved above some moving averages. You've got some upward slope, but again, mixed signals. crossed bearishly. Do we go to plus one? It's just like financials. It's the same dynamic. It is acting a little better. So if you want to go plus one on consumer, you're in that 0 to plus one type of idea. Technology, you're not. This one acted poorly, really dragged the markets down, and I suspect has in its sights some lower levels down there that it may go and touch. So I think this week you've got to downgrade technology and say that that's a leadership group leading us lower. The part of the reason I didn't go to a plus one on financials and consumer stocks was really where I think technology's leading the market as a whole, and I worry that they're going to succumb to that pressure. Materials, a little bit more choppy to negative. If you wanted to go minus one, or I still think it's a 0. You've got sideways slope, you've got mixed up. It's just really a 0. And then energy, a little bit of a downgrade this week because I still think we may be due for a little bit of a correction, but it's still bullish. I mean, you just take your opinion away, look at the chart, and you'd say, well, everything is so clean. 20 above 50, above 200, upward slope, golden cross. I mean, everything looks pretty good. The only concern is it's just been so good for so long. Maybe we get a little bit of a correction, a fake out of sorts. But energy, wow, what a great sector. So as we look at the groups, I mean, I'm energy and communication services a little bit more positive. I could see financials and consumer just nudging that way. Materials, utilities, more in the 0 camp. Tech, healthcare, real estate, a little bit more in the bearish camp. Industrials are the obvious bear right now. Trading poorly versus trading well. So this is the trade that's been working. Energy up and industrials down. Some of these others, I think you're still, as you kind of look at this, it's skewed a little bit more bearishly, neutral to bearish, and that's my opinion on the broader market. So tech, very good chance it leads us to the downside. Now, possible trades. So industrials to start. Here's FedEx. Now we highlighted, I did the trading room 2 weeks ago. We highlighted a bearish trade in UPS. That hit expiration for max gain this week. FedEx, a competitor, bearish engulfing type of formation, bearish crossover just happened, downward slope. You can argue it's kind of retesting this little breakdown point. We're going October 20th, 250, 260 bear call spread. That type of trade is about a 1-to-1 type of reward to risk ratio. The trade's successful if we're below 250 at expiration, unsuccessful if you're above 260, and you could go either way, but we think more than likely to be pushed to the downside. This is the industrial sector, still an underperforming group. So FedEx we like on the bearish side of things. Consumer stocks. So here we've got Las Vegas Sands, and you can just see horrible price action. Breakdown here. After that sharp breakdown, you'd think that there would be a bounce and a correction back up. All this thing can do, even in this oversold condition, is just low base. These are patterns that tell you there's more to go. The way we're looking at it is expect more to go, but expect some choppiness. So it sets up really well for a butterfly. You can do an October 20th, 50, 45, 40, put butterfly. And a butterfly, you've got your risk graph. Here would be your break even. Here would be your profit. Here would be your loss. And then the prices would be down here. And the way that this is constructed, so you'd have 40, 45 right in here, 50, and so on. You'd have max losses if it was at 50 or at 40, 40 and below, 50 and above. But you'd have profit anywhere in this zone here, and the closer it is to 45, the better. Well, the stock's at 48.74, so what we're really saying is we think there's going to be a little more downside in the next couple of weeks, but it might get sticky around that level. In other words, we're not expecting a plunging move that just collapses and can't recover and can't get off the mat. It's more like, well, we're going to go lower, but it might be a nice risk to reward. These trades have very favorable risk to reward ratios where you're risking a little to make a lot. Kind of a nice opportunity there in Las Vegas Sands. On the tech sector, AMD, this is a semiconductor. You saw the ARM IPO. AMD has been in a downward trend. It's got a perfect, clean downtrend line. You could channel off of that and say, well, if you were projecting where this thing could go and doing some channels or something, the answer is lower, lower than where we are and such. And the way we were looking at this is pretty conservative. You could just do an October 100, 105 bear call spread. You lose if you're above 105. You make max gain if you're below 100. That 100 marker is a psychological. It's a whole round number. People focus on numbers like 100 per share, and notice that's exactly where we bounced previously. We think we're just within a whisper of that, and we should break it this next time down. And once you break it, now that old psychological resistance or support in this case becomes resistance. And when that support, that psychological 100 support gives way, that's where a lot of stop losses and speeding up of the process of selling can take place. So AMD, I think it makes sense as a 100, 105 type of bear call spread. And then last but not least, we do have one bullish idea here in Barrick Gold. Now, this is a big idea that's really a trend reversal. You have broken out above the prior highs. You had plunged here. You can see a little bit higher low than the prior low. So you're actually in a little bit of a pivot uptrend. You've cleared the 50 period moving average, and notice the volumes increasing. We don't want to get too carried away on this, but you can actually trade a very interesting diagonal call spread. Buy the November 16, sell the October 18. The 18 is way up there, but provides a little tiny bit of income and frankly is very likely to expire, but it gives you a little bit better price, and we'll see if this thing can work its way higher towards 18 by November expiration. Now, if that happens, it's a home run because you own what would then be in a deep in the money 16 strike call. But here, I think that 18 level is sort of the next level that this thing is moving towards over the next couple of months. So it's a pretty aggressive diagonal call spread type of structure. Buying the 16 in the money, selling way out of the money. Once the 18 goes away, you're just in a long call, and we'll see where we go from there. Kind of interesting there in the gold miners. In conclusion, neutral outlook, but leaning a little bit more on the bearish side. We're busy next week. We've got the market roundups on Monday, Tuesday, Wednesday, Thursday. We'll send out those updates. I hope you enjoyed this trading room. Thanks everyone for being here. We'll see you next time.